Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm going to talk about tech stocks that are on sale after the March sell-off. Or are they on sale? I wasn't sure, but I picked 3 of my top tech stocks to take a look at to see if maybe I could get them cheaper now, because if we liked them a month ago, we certainly are going to like them on some kind of pullback or sell-off, because who doesn't like to get something on sale? Although many stock investors seem to get afraid when something goes on sale versus rushing out to buy it like we do every other item. But we're going to take a closer look at 3 of these top tech stocks. Now, I'm not covering any of the Mag 7s on this episode. If you're like me, you're probably a little tired of constantly hearing about the Mag 7, what they're doing, how much they've sold off, how expensive they are. I've covered this a lot on this podcast. So we're taking a little break for them because there are other top tech stocks out there other than the Mag 7s. And I'm even looking beyond, the semiconductors and some of those stocks to take a look at some software names and a cybersecurity giant, because again, if I could get these a lot cheaper, maybe I'm interested suddenly. So as the Zacks Value Stock Strategist, I'm always looking for a deal. And often we haven't gotten it on these top tech stocks, but are they cheap here? Is this a good buying opportunity? Let's dive in on 3 of these top names. Okay, the first one out of the gate is going to be ServiceNow, ticker N as in Nancy OW. I've talked about ServiceNow many, many times on the Earnings All-Stars. The chart is insane. It has been a beast. And now it's involved in the AI revolution on top of everything else it was already doing. So this is a software name. And I always go to the websites to kind of check out what exactly do they do, because with a lot of these tech companies, it's kind of like, they're like out there, they have a product that goes out to all these customers, like global companies, Fortune 500, but you can't really figure out what it is they're doing unless you work at one of these companies and use this product. So ServiceNow, on their website, it says, "We make the world of work better." So that's a little bit, kind of not very concrete. That's what I'm talking about with these companies. But then they said they have an AI platform for business transformation. They also make most of their revenue off of subscriptions. So that is always key for me, that this is a software company and people are buying the software and then they're paying monthly or yearly to get it. So for fiscal year or full year 2024, they made $10.7 billion in revenue. Subscription revenue was up 22.5% year over year. They have $3.5 billion in free cash flow. They have 8,400 customers worldwide. And year to date, these shares are now down 24%. And over the last month, which was the month of March, they fell 12.5%. So let's take a look at my favorite chart, the price and consensus chart on Zacks.com. So those of you who are listening in, I'm going to try to describe it. And then everyone else on YouTube, obviously, you are looking at it right now. So this is ServiceNow. If we scroll up, you can see there's the ticker. It is a Zacks number 4 rank. I'm kind of surprised by that, which is the sell. And it's not a value. According to the style score, it's got the F for value. Not surprising. ServiceNow has been expensive on a classic valuation basis for a while, but is it cheaper here now that it's crashing down kind of here in 2025? This could be a incredible buying opportunity. So looking at this price and consensus chart, this is one of the awesome price to consensus charts I'm always looking at. It's up and to the right, just very consistent growth year over year. Looks like double digit growth there. And so that's why the stock was soaring going into this year. But why, you're asking, would it be selling off this dramatically if it looks so great? Well, the PE here, I'm switching over to the detailed estimates page. The PE is at 49 times now. That is off of what it used to be, obviously, because the stock has pulled back. But 49 times, not cheap on a PE basis. Even looking at the PEG, we're still at a 2. That's not under 1 where we would have growth and value, but that's pretty low. I'm still liking that. And then looking down at the detailed estimates. So for 2025, sales expected to be up 18.69% this year, another 19% in 26. And then we do have the nice double-digit earnings growth year over year. It has continued to do this, up 16.5 this year and then 19.8 next year. Why are we getting the number 4? So we have had some cuts. Some analysts may be taking it down just a little bit here. For 2025, one has been cut in the last 30 days, but 2026 is looking one in the last 7 days there. So that's a little bearish. Nobody's been raising in the last 60 days for either year. But overall, even for 2025, like I said, 1622, it's only down 2 cents from 1624. That's $16.22. So a 2-cent decline. I'm not too worried about it. And then for 26, it's actually up 2 cents, even though one estimate has been cut there. So none of this is screaming, danger Will Robinson at all. Nobody's should be freaking out that anything is changing in the story that is here for ServiceNow. But everybody has been locking in those gains from the all-time highs there in 2024. And now it's come down considerably. And so I'm kind of liking where we are here on ServiceNow. But as I've been telling people on a lot of my trading service newsletters that I run here, this sell-off here in 2025 is obviously tariff related, the uncertainty around that. But I feel like it's a lot of re-rating on some of these growth stocks, including the tech stocks that are fit in that category, and that valuations got a little too stretched, even with the good underlying fundamentals that are going on here. Paying, 50, 60, 70 times earnings was just getting a little too hot to handle. And so now we're getting a re-rating of some of these companies back down to at least a little more realistic levels, with that 49 PE that is more realistic. So ServiceNow looking kind of interesting here on this big sell-off. And will it go any cheaper? We don't know yet, but I would definitely be having this on my watch list. If I liked it in 2024 and I'm looking for the software AI type of play, then it should still be on the short list here. So ServiceNow, ticker NOW. And then, of course, we have to talk about Palantir, ticker PLTR. And Palantir Technologies, I did the same thing because I know many of you know of it. Maybe you're even invested in it, but you don't really know what it does. So they are a leader in AI. They are foundational software of tomorrow delivered today. Now, the thing with Palantir that has a little bit of investors spooked out is that they do have a lot of government contracts and business with the government. So for last year, fiscal 2024, U.S. commercial revenue was up 54% to $702 million, and U.S. government up 30% to $1.2 billion. So government revenue, those contracts, is actually bigger than its commercial business for right now. So that's something to keep in mind. And again, had people a little freaked out. But fiscal or full year 2024 revenue up 38% year over year to 1.9 billion. And full year 2025 revenue guide of up 31% to 3.7 to 3.74 to 3.75 billion is the guide they gave for 2025. So that's pretty healthy. They've adjusted free cash flow of 1.25 billion. That's with a 44% margin there. So pretty healthy free cash flow as well. Year to date, the shares are actually up 12.8%. But over March, when we had the more difficulties, even Palantir pulled back, but only a little bit, it turns out, down just 2.8%. Let's look at what it looks like on my favorite chart, the price of consensus chart. And this one, a little different than what we just saw with ServiceNow. It is up and to the right, but it's narrower lines up and to the right until you get to 25 and 26, and it starts to spread out a little bit. That means the earnings growth is a little bit stronger there for this year and next year. And we can see the analysts starting to raise here in 2025. So they like what they heard on the last earnings report and that earnings and revenue guidance, and they have been raising. But as you can see, the shares did top out earlier this year and then have just pulled back down over the last couple of weeks, maybe a little bit more out of the 1 month period, as you can see, because we're only down 2.8% over the month, but you can see it kind of turning back down there as we head here into April. So what do the detailed estimates look on Palantir? It is a Zacks number 3 rank, by the way, but also an F for value. And not surprising again, because the stock was very expensive going into those highs. So scrolling down, this one has a PE of 151 times. So it was trading well above that previously, and now still expensive, even with this little bit of weakness here off of those highs. And so if we're looking for a re-rating, I'm not really sure this is it on Palantir. Nobody's really re-rating it, but PEG ratio of 4.8. So that's not cheap either, but there's a reason everybody's paying up. So this year, as I just said, they gave that revenue guide of 31%. The analysts are at 32% now for the revenue guide. Actually, I have year-ago sales of 2.87 billion. So I'm not sure where I got 1.9, but that might have been just a slip of my pen there. But it was 2.8, and now we're looking for 3.74 to 3.75. The Zacks consensus is at 3.79. So the analysts are a little more bullish. They know that maybe Palantir is guiding a little bit conservatively, even with this very generous guide. And then 26, they're looking for another 27.9% in revenue growth. So I'm not really seeing any kind of decline here just because of austerity in the government. We're not seeing that at all in these numbers so far. Earnings expected to be 56 cents versus 41 cents last year. That's a gain of 36.6%. So this is where you're starting to see this big separation in the lines on the price of consensus. And then 2026, another 25.7% gain up to 70 cents. We have 10 estimates higher in the last 60 days. So after the last earnings report and that guide, everybody raised. And for 2025, but 5 also raised for 2026. Nobody's raised since then, and nobody has cut. So this is going to be an interesting one, this next earnings report, to see if anything that's going on in the government is having an impact now on anything they're seeing for the full year. So Palantir, it's a little bit on sale. It has come off those highs, but it's not altogether re-rating like ServiceNow is. So a little less of a deal here with Palantir, but certainly one to look on your short list and keep it there because it is off those highs. And maybe if we get a little more weakness here, it'll become more of a deal. But you got to like that earnings growth and revenue growth. So it is producing and executing on both sides. And you got to love it if you're looking for a tech stock. So Palantir, PLTR. Then we're going to wrap it up with the stock that everybody loves on the cybersecurity side, Palo Alto Networks. Is it possible to get Palo Alto Networks on sale? A lot of people would have said no. This is also one of the beasts of a stock that I follow a lot on the Earnings All-Stars because of its phenomenal chart. They are, as I mentioned, a cybersecurity company. On their website, they call themselves the global cybersecurity leader. And they had a great second quarter of fiscal year 2025. So they're on a little bit different calendar. So we're going to just look at the quarter for them. Revenue was up 14% to $2.2 billion. Second quarter adjusted free cash flow of $509 million. That's something all three of these companies have in common. Great free cash flow. They're just basically churning money. They expect $750 billion in AI-driven infrastructure investment. This is in the industry by 2027. So that's not that far off. $750 billion. It's big numbers. They've done this new strategy called platformization. Can't even say that word, platformization. And it's taking hold. They see strong demand for their network security. They have 37 plus adjusted free cash flow margins. That's what they're expecting. 37% plus growth, or higher, 37% or higher on the margins for their free cash flow through fiscal year 2027. So just a reminder, Palantir had the 44% margins on their free cash flow, and they're getting 37. These are all great numbers. And let's take a look at their details and that chart. So Palo Alto Networks is a 3, also an F for value. No one's surprised. Its growth and momentum score is not as good as some of the others. D for growth and B for momentum. So it has an overall D rating now in Palo Alto Networks. But look at the price consensus chart. It is up and to the right. It looks a little bit more like ServiceNow, at least for this year and next year. Just the analysts are cued in. They are seemingly kind of confident about these numbers, at least now that we're in 2025. There's a little bit of increase there for 2025, 2026, as the estimates were adjusted a little bit off of this last earnings report. What has the stock done? Year to date, it's down, but just 6.2%. And 1 month, though, here in March, it was down 10.5. And you can see it on the chart. You know, it's kind of hitting these all-time highs like it did in 2024, or it became very close. It was rejected, and now it's fallen back. We seem to be at another kind of critical level here, and we'll see if it falls back a little bit more or not. Now, what do the detailed estimates look like on a stock like this? Scrolling down, we have revenue growth of 14.2 for this year, 14.47 for next fiscal year. And we just had second quarter, so we are in the back half of this fiscal year. That is respectable, double-digit growth. You have to like it, but not as strong as what we've seen with some of the others. Earnings 13.38 for this year and 12.7 for next year. That's also very nice and respectable, but not as strong as what we saw with Palantir or even ServiceNow. But the problem with Palo Alto Networks is it is still an expensive stock. Scrolling up, you can see the PE there of 52.97, or basically 53 times. This stock needs a re-rating. It's still got the good growth on revenue and on the earnings side, but not nearly as hardy as some of the others. So you have to start to ask, why am I paying such a high price, a high valuation for what is good earnings growth, but not like spectacular earnings growth like we're seeing with Palantir. So will this get a bigger pullback here and a bigger re-rating down so that some of these valuations pull back down a bit? And then people are willing to pay up for this earnings growth and revenue growth at a slightly lower valuation. Now, it does have a PEG of 2.6. That's not extremely high. It's not a value either, obviously, but it's fairly attractive. But I feel like that PEG has to also move down. Now, I know some of you are saying, but Tracey, nobody looks at PEs for the tech stocks. So why are you looking at it? I'm sure it's more attractive on the price to sales ratio. So I'm just switching over on Palo Alto Networks to the financial overview. And you can see right there on your screen, price to sales is 13.1. And anything over 10 on the price to sales ratio with any stocks, but certainly the technology stocks, is considered to be pretty stretched. That is an expensive price to sales ratio on a tech stock, even with this growth. So Palo Alto Networks still not cheap even on that. But let's take a look at the other two while we're on this page. Palantir, price to sales, wow, 69 times. Remember, they got a PE of 151. So I knew it was going to be high, but 69 times, that's pretty up there. We definitely need a, some kind of re-rating on Palantir. But again, I am the value stock strategist here at Zacks. So these things are a little outrageous to me. But ServiceNow, ticker NOW, 14.9 on its price to sales. There it is right there in the green highlight. So none of these stocks are cheap whatsoever on the price to sales ratio, and those are very stretched. And so I'd like to see them back down under 10. If I could get any of these under 10 on the price to sales ratio, I would consider that to be quite a deal on these. And I would be looking, seriously at them, even as a value investor. But all three companies crushing it on the revenue, crushing it on free cash flow. They've got the growth there. So that's why they're growth stocks. But I'd like to see a little bit more retracing here and retrenchment in these stocks to give the valuations a little bit down off of these sky high nosebleed levels. The most attractive out of the three, because it's pulled back the most so far, is ServiceNow, ticker NOW. So I'm keeping all three of these on my watch list. And I'm also watching the Mag 7s, who are actually far cheaper than any of these three stocks now that we've taken a look at them. Yes, even probably Tesla is cheaper than all three of these. And Tesla is the most expensive on a fundamental like PE, price to sales basis of the Mag 7s right now. So Mag 7s looking a lot more attractive compared to some of these other tech names. So I'll be checking in on these as we go along here this year in 2025. But for now, they're all on my short list and watch list to keep an eye on what's going on. So let me recap the stock tickers again. We had ServiceNow, which I keep mentioning, ticker NOW. We had Palantir, P as in Paul, L as in Larry, T as in Tom, R as in Robert. We had Palo Alto Networks, cybersecurity, P as in Paul, A as in Adam, N as in Nancy, W, PANW there. And as always, I aim to bring you whatever's going on in the stock market every week. And we're going to have those tariffs going on this week as I'm recording this, the first week of April 2025. So a lot of talk. It's probably going to be on the podcast about the consumer stocks, manufacturing, a lot of things going on. Be sure to subscribe. Get us on YouTube, Zacks.com/YouTube. Get us on Apple. We're on Spotify for the audio podcast, but get us somewhere. And I'll see you again next week with some more stocks.